we're picking up where we left off in class. We were finishing up the basis considerations. So we had just talked about if there was a lump sum purchase and looked at that, and now we're moving on to continuing to talk about allocation problems. And so if a business is purchased and there's goodwill involved, then when that happens, we'll assign the purchase price to the assets, excluding goodwill, based on their fair market value, and then assign the residual amount to the purchase price to goodwill. So for example, if we purchase a building for $100,000, but their assets, the fair market value of their assets was only $80,000, then we would assign the $80,000 to the assets and the $20,000 to goodwill. And that applies to both the purchaser and the seller. Then there's also an allocation problem when there's non-taxable stock dividends. And so when that happens, the basis of original shares is allocated over the original and the new shares, based on the number of shares common to common, or based on the relative fair market value if you're getting preferred stock on the common stock that you own. And so, for example, if you bought, we'll just say 100 shares for $1,000, so it's $10 a piece, and then you receive non-taxable stock dividends, another, we'll just say 100. So now you would just take the fair market value of that 1,000 and divide it over the 2,000 or 200 shares that you have, and so it would be putting the price at $5 a piece rather than the 10 a piece. And when that happens, the new shares that you receive will adopt the holding period of the original shares, and that becomes important when we're looking at how they're handled when they're sold as far as the gain. Then we move into gift basis. If a taxpayer receives property as a gift, the recipient of the gift has paid nothing to take ownership of the asset. So how we defined previously in the slides that the transaction takes place. Well, with a gift, the donee or the recipient hasn't paid anything, but they did take ownership, and so that creates a problem, because under the cost basis provision, that means the basis would be 0. And so then if they sold the property, all of the amount realized would be treated as a gain, which then doesn't make it a gift, because whoever gave the gift to them already, they did pay for the property itself, and so had they sold it, they would have had a basis, and so we have to figure out how we're going to handle the basis when a gift is given, and that's what we'll do in the next few slides. And so because of this, the basis is assigned to the property depending on the date of the gift, the basis of the property to the donor, the amount of the federal gift tax paid, and the fair market value of the property. The fair market value of the property on the date that the gift exceeds the donor's basis. If the fair market value of the property on the date of the gift exceeds the donor's basis, then the recipient's basis is the carryover basis. If the fair market value of the property on the date of the gift is less than the donor's basis, then there's a special dual basis rule that applies. And whether it's a gain or a loss may differ. So the basis is dependent on the relationship between fair market value at the date of the gift and the donor's adjusted basis. So when there's a subsequent gain, so when a gifted asset is disposed of by the donee, the basis for calculating any gain is the donor's adjusted basis, or the carryover basis that we talked about in the previous slide. And the basis is referred to as the gain basis, and it will be increased if the donor incurred gift tax on the gift. So that means that, if they they adopted the gift or the basis of the fair market value at the time of the exchange, and then also paid tax on it. So let's say that the fair market value is 1,000, and then they paid 20 in tax. They would have a basis of 1,020, and the holding period for the donee includes that of the donor. So they get to just adopt the holding period of the person who gave them the gift. When it's a loss, it's handled a little bit differently. The basis for calculating any loss is the lesser of fair market value at the date of gift or the donor's adjusted basis. And we call this the loss basis. And in the case of a loss, then the holding period starts on the date of the gift. So when it's a gain, they get to have the advantage of it being long-term, assuming that whoever gave it to them had already held it for more than a year. When it's a loss, then they have to take the period as when they received the gift. They don't get to include that of the person that gave them the gift. If there's no gain or loss, so we're looking at a situation where there's a dual basis and the amount realized from the disposition is nothing. It's not a gain or a loss. Then there's no gain or loss realized, and there's no need for determining the holding period because that's only necessary when we're determining how to treat the gain or loss, which we wouldn't need to do if there wasn't one. The adjustment for the federal gift tax. If federal gift tax was paid by the donor on the transfer, the portion of the gift tax paid related to any appreciation is considered in determining the donee's gain basis. And as far as the holding period, the property acquired by gift begins on the date that the donor acquired the property, if the gain basis rule applies, or the date that the gift was received, if the loss basis applies. So we kind of already talked about that in the previous slide. And as far as the basis for depreciation, it's the basis for depreciation on a depreciable gift property is the donee's gain basis. So they give us an example where Alex received a gift from Beth on June 15th this year. The fair market value of the assets was $8,000. Beth bought the asset on May 11th, 1985 for $10,000. So with that information, if Alex sells the asset for $11,000, there would be a $1,000 gain because it would be the Beth's basis of $10,000, so $11,000, the selling price minus Beth's basis of $10,000 gives us a $1,000 gain. If Alex sells the asset for $7,000, then there's a $1,000 loss because in that case, we would use the fair market value as the date of the gift of $8,000. So the $8,000 less the $7,000 is a $1,000 loss. And if we sell it for $9,000, then there is no gain or loss. And so there's no need to look into that any further. When we have a case where property is acquired from a descendant, generally, beneficiary's basis is inherited assets will be the fair market value of the asset at the descendant's date of death. But there is an exception if the executor or administrator of an estate elects an alternative valuation date. The basis is the fair market value on that date. And inherited property is always treated as long-term property. So that creates kind of a benefit because if the beneficiaries want to sell the property and get the cash out of it, they don't have to hold it for a year before they sell it to take advantage of the lower tax rate. So as far as the valuation date goes, the date assets valued for estate tax is either the date of the descendant's death, which is the primary valuation date, or 6 months after the date of the descendant's death, which is called the alternative valuation date. And that can only be elected if both the value of gross estate and the estate tax liability are lower than if the PVD, or the primary valuation date, would have been used. So if that's the case, then the executor can elect to choose that alternative date. When PVD is used, the beneficiary's basis is the fair market value at the date of the descendant's death. If the alternative valuation date is used, the beneficiary's basis is the fair market value at the earliest of the date the asset is distributed from the estate, or 6 months after the date of the descendant's death. So whichever of those two comes first. So we have an example. At Rex's date of death, April 30th of this year, his assets had an adjusted basis of $200,000 and a fair market value of $700,000. If the primary valuation date is selected, the assets are distributed on June 30th. Beneficiary's basis is $700,000, the fair market value at the date of death. So continuing with that problem, October 30th of this year, 6 months after the date of Rex's death, the assets had a fair market value of $650,000. If the alternative valuation date would be selected and the assets are distributed on November 10th, the beneficiary's basis will be the $650,000, the fair market value on that date. If it's selected but the assets are distributed on June 30th when the fair market value is $670, then the basis would be $670. So it's still less than the $700,000, but it's based on whichever came sooner. And so since the assets were distributed on June 30th, they have to use that date, even though a few months later in November it would have been less. And we also need to consider income in respect of a descendant, and so, or that's abbreviated IRD, and so that's most frequent when frequently received by descendants using the cash basis of accounting, and so that includes post-death distributions from retirement plans, including traditional IRAs and 401k plans. The income in respect to death, or in respect of a descendant, is included in the gross estate at its fair market value. It's not subject to the step-up or step-down rules applicable to property passed by death. And the income tax basis of the descendant transfers to the estate or heirs. So, for example, if I received income from a family member who is in, let's just say like the 32% tax bracket, and I'm in the 25% tax bracket, I would pay 25% tax on my other income, but the portion that I received from that family member who was in the 32% tax bracket when they died would be charged at 32% tax. Which makes sense because it's really just receiving their income. So had they lived, a few more days to receive their check, they would have paid the 32%. As far as a survivor's share of community property, so we're looking at a scenario where a group of people own property and then somebody within that group dies. Both the descendant's share and surviving spouse's share of community property have a basis equal to their fair market value on the date of the descendant's death. The surviving spouse's share is deemed to be acquired from descendant. If we're in a common law state, only half of jointly held property of spouses is included in the estate, and so in that case, there's no adjustment of the basis permitted for the surviving spouse's share. Now we'll run through the disallowed losses. So you're not allowed a loss for related parties. So when you sell or exchange good between related properties, if there's a realized loss on the sale of assets, it is disallowed. And so related parties include family members, a corporation, a shareholder who owns greater than 50%, directly or indirectly, indirectly meaning like they own a corporation that owns a corporation sort of thing, where it's not as direct. Or a partnership and a partner who owns more than 50% of the partnership. The reason for the disallowance is to prevent a taxpayer from directly transferring an unrealized loss to a related taxpayer in a higher tax bracket, who could then receive greater tax benefits by recognizing the loss, and also to eliminate a substantial administrative burden on the IRS. So if we're transferring income producing or business property to a related party, any loss is disallowed. The related party buyer's basis is equal to the amount paid. So if I bought property, like a business from my mom, and bought it for $50,000, which created we'll just say like $10,000 loss, the loss is disallowed, and my basis becomes that $50,000 that I paid, even if her basis was the $60,000, which created that $10,000 loss. And then there's also the right of offset. So for income producing or business property, any loss disallowed can be used to reduce the gain recognition on subsequent disposition of the assets to an unrelated party. So if I then take that business and sell it later at a loss, I can sell it at a gain. So we had that scenario where it was valued at 60, I bought it for 50, but I didn't get that $10,000 loss was not approved. But then we later sell it to somebody else for 80, I can reduce the gain by that $10,000 loss that was not recognized originally. It's only available to the original transferee and not available for sale of personal use assets. So not like I bought a car from my mom, but if it was the income producing or business property. As far as the holding period goes, the holding period of the buyer for the property is not affected by the holding period of the seller. The buyer's holding period includes only the time that he or she holds the property. So like in that case of buying my mom's business, it's the day that I acquired it, even if my mom has operated the business for 5 years. Wash sales. If a wash sale occurs, any realized loss from the wash sale is disallowed. And so what exactly is a wash sale? A wash sale occurs when the taxpayer disposes of stock or securities at a loss and acquires substantially identical stock or securities within 30 days before or after the date of the lost sale. And so this is essentially preventing somebody from selling stock just for the sake of creating a loss and then immediately purchasing it back. And I mean, obviously not immediately because it's within 30 days, but so it's preventing them from taking advantage of that time frame to sell the stock at a loss and then try to purchase it back while the price is still low, and like use it to turn an unrealized loss into a realized loss, even though they intend to continue to hold it. With wash sales, a disallowed loss is added to the basis of the substantially identical stock or securities that caused the disallowance. The basis of the new stock or securities includes the unrecovered portion of the basis of the formerly held stock or securities. And the holding period for the new stock begins on the date of the acquisition of the old stock. And so since it's a wash sale, it's almost like it didn't even happen. Like we're updating the basis and the holding period of the new stock as if we just continued to hold the stock that we had. When a taxpayer acquires fewer shares than the number sold, then the loss from the sale is prorated based on the ratio of the number of shares acquired to the number of shares sold. So, for example, if we sold 1,000 shares at a loss and then we purchased back 800 shares of like relatively identical shares, then only the 800 would qualify as wash sales, and so we would still have a loss on those 200 that we could prorate based on that ratio of the 800 over the 1,000. It does not apply to taxpayers engaged in buying and selling securities, and it does not apply to gains realized on the disposition of securities. When property is converted from personal use to business or income-producing use, that we have to look at how the basis is handled in that switch or change. And so as far as personal use assets go, there is no loss for disposing of personal use assets. Or, I mean, I shouldn't say that. There could be a loss, but it's disallowed. And the personal use asset loss cannot be converted into a business or production of income use deductible loss. The original loss basis for an asset converted is the lower of the asset's adjusted basis or fair market value at the date of conversion, and then cost recovery basis is similarly limited. And so the basis for the loss, when we're looking at personal use assets, the basis for the loss is also the basis for depreciating the converted property. There's an exception to the general rule that the basis for depreciation is the gain basis. It prevents the taxpayer from recovering a personal loss indirectly through depreciation of the higher original basis. And both basis for loss and basis for gain are adjusted for depreciation deductions from the date of the conversion to the date of disposition. And so that covers this chapter, and I'll send an announcement with more information on how we'll proceed with the end of class and updating the XP points for everybody and what we'll be doing on Thursday, because I'm not positive I'll be able to make it or not, because I'm thinking that we'll still be in that like contagious time frame. So stay tuned.